Hi, welcome everyone, and thank you for joining today's masterclass. Today we are going to deep dive into fixed assets review when we start correlating fixed assets with plant operations, project records, maintenance logs. The discussion keeps creating several branches because the human mind can easily lose track of these complexities. We highly recommend creating process flowcharts to map out branches and risks while documenting our thoughts. While process flowcharts will be a topic for another day, today we are sticking directly to the fixed assets and shop floor realities. Let's directly dive in and let me ask you a question. Have you ever reviewed fixed assets in a manufacturing plant? Here is the truth. When reviewing fixed assets in a manufacturing plant, 99% of the audit team makes fundamental mistake. They bring the fixed asset register, the FAR, from the finance module, walk down to the shop floor directly, find the machine, maybe with help of a supervisor, take the box, and think they are done. That is merely basically a financial verification. A true risk advisor always knows that if you want to find the real anomalies, you must cross reconcile the finance fixed asset register against various other sources. That applies for anything, right? And in this case, what we can verify it with, this is a manufacturing setup. You can verify it with plant maintenance module or project records. When we bridge the gap between financial ledger with the shop floor realities, it exposes massive frauds and process gaps. When you tally them, you typically find two massive variances. Okay. First one is the ghost assets, meaning the finance department is carrying the assets on the book, but the engineering team has no record of it in their plant maintenance module or system. This leads to a severe safety hazards because the machine is omitted from the mandatory safety checks, or it points to premature capitalization where finance claimed early tax depreciations or uncommissioned equipment. It could even mean the machine broke down, it was cannibalized for spare parts, and the finance is still paying insurance on a pile of scrap and claiming depreciation whatsoever. The second variance in this is the obviously the exact opposite, the shadow capex. The maintenance team is spending time and spare parts servicing a machine every week, month, year, whatever the schedule is. But the finance doesn't even know it exists. This points to the OPEX smuggle, where a manager bypassed board capex approvals by splitting invoices, booking a heavy machine as a consumable or repair expense. It may be a deliberate tax misstatement, leaving the asset completely uninsured, and you might even end up spending company money maintaining a vendor's equipment lying on your site, and your maintenance team is maintaining it. Now, take another aspect. Now, let us step out of the main plant and look at the blind spot, the maintenance shed. Statutory auditors often rely entirely on the site supervisor to identify machines. Simply matching tags, machines matching tags to the ledger. But as internal auditors, we must operate with a barrier-free mindset. When you walk into the maintenance shed, look at to the sides. You will often find plethora of heavy equipment that does not exist in the finance FAR, and it is completely missing from the plant maintenance ERP. We call those zombie assets. A critical machine breakdowns. Finance capitalizes a brand new replacement and officially writes off the old one as a scrap. But on the shop floor, engineer quietly refurbishes that old machine and keeps it in the shed as a spare. It is a prudent mindset. There is no problem in the mindset of the maintenance team. In heavy manufacturing setups, these off book refurbished machines can take up to 10% of the equipment count. I'm not talking about the value here because value is a different topic. We will touch about it on it shortly towards the end of it. But 10% of the total equipment count, I've seen it several times. These off-book assets cause massive corporate risks. If something does not exist in your book, it can something gets um, siphoned off. There is a risk of theft, and you will never know about it. Operational sabotage, when the undocumented spares fails, cost center bleeding from the secret maintenance. You are spending maintenance budget on, let's say, 10 equipments, but you actually have 12 which are getting maintained. Or massive tax evasion allegations. So what to do? How do we systematically prevent these zombie assets? So first, you correlate maintenance schedule with the equipment master to trace inconsistencies back to the fixed asset register. But the real control starts at the purchase level. Every capex requirement sheet, business case, purchase requisition must have a mandatory tab asking if the request is for a replacement of a asset or a new asset. It is If it is a replacement, the system must automatically mandate to put in the asset code and the equipment code for the asset being replaced. Furthermore, before the new asset arrives, there must be a strict timeline to provide the replaced equipment to the store. The store must act as the ultimate custodian of all the discarded assets. The decision to repair or scrap must be made at the store within the ERP. From there, the asset can either be transferred to a sub-store for refurbishment or officially scrapped. If you don't have this control, you will always have a ghost store of refurbished equipment. Now you might think you understand the risk of large equipment like an EOT crane, but I say tracking equipment spares is even trickier trap. When a giant turbine or a EOT crane is ordered, I'm taking these examples because these equipments pretty much everyone would have seen in a manufacturing setup. It usually arrives disassembled and customized for the company. Smart purchasers often negotiate a set of spares like expected 10-year requirements for wire ropes or brake shoes of a EOT crane, along with the primary equipment. And here is where the process breaks. The purchase order usually has a single line item for the entire machine. A EPC contract, a project line item, one single line item, EOT crane, 60 ton, meaning everything that comes with it goes directly into the to the project team through a single line item of the purchase order. The purchaser does not want to be putting thousand line items of a large equipment in the PO. So account team also capitalizes the full value of the PO in a single line item. While the spares should have ideally gone to the inventory, they instead go left in the empty crates on the shop floor with the operations team or dumped in the maintenance toolkits. When these spares are eventually consumed, say replacing a wire rope after 6 months, they reduce the total asset value that was originally capitalized. To make it easy to understand, imagine your car gets a flat tire and you ran some kilometers with it. You damaged your rim also. So you have a damaged tire and a rim. You replace it with the spare wheel from your trunk and throw away the damaged original. I don't mean to say the second one is a duplicate, but the idea is original one is the one which is the four tires on which your car is running, and the spare tire which is kept on in your trunk. So unless you buy a new spare, you now have a lesser car than you originally capitalized because you initially capitalized a car that included a spare tire. So coming back to our EOT crane and rope or brakes. So if they order a brand new wire rope instead of using the spare they already have lying around, that is an entirely different financial leakage. You have a lesser equipment and you it is still capitalized at full. Okay, this has several more aspects to it. Maybe I'll touch down on it on when I'm talking about spares in some other video. But again, today sticking to the finance fixed assets. So when you are trying to put this observation across, you will face a lot of defense from the management. So how do you handle this? You don't have enough documents, enough material to capitalize your asset, capitalize your observation. So we adopt our Trojan horse strategy. When you uncover these ghost assets and missing spares, you cannot just tell the finance side to write them back into the fixed asset register. They will fight you, they will never allow that. They will claim that it is a material scrap, it does not meet accounting standard definitions. What you will need is a detailed list of these assets. For just pointing out assets 1, 2, 3, 4, 5 will not make sense. And you are auditors, you are not mechanical engineers at times. I'm not saying there are not mechanical engineers who are not auditors, but most of them, you are accountants, commerce or MBA or chartered accountant students or professionals. You need the plant engineers to make this list. And if you tell management it is for an accounting correction, they won't ever support you. And this is where you use my Trojan horse strategy. You go to the management and say, sir, we have an untracked equipment lying around. We need to create a physical tracker to secure those assets from theft, pilferage, and to ensure basic safety maintenance. To this, management will never say no because this is something which is securing their asset and not hampering their fixed asset register or the reporting mechanism. These are anti-theft and safety controls, and they will sanction the engineers to build on your list. You work with these. Once they hand over that list to you, you will correlate the codes of these zombie assets with their brand new counterparts in the FAR. Apply a heavy depreciation adjustment. Calculate defensible estimated valuation. If that valuation is, let's say, 50 lakhs, you hit them with a high risk observation back to with the hard data, and finance has nowhere else to hide. If it goes otherwise, obviously you drop it. If it is, let's say, goes 5,000, 20,000, 30,000 rupees, you might just put it as an improvement opportunity or as something low value line item. You leave it. These topics will go into our flow into our another video for another day. But today, I have give you enough food for thought. Think about it. Auditing isn't just about knowing the rules. It is about knowing how to navigate the business and play the game smartly. Whether it is enforcing store custodianship for a replaced EOT crane or tracking the capitalized spare tires in your metaphorical trunk, you must look beyond the ledger. Thank you for your time. I highly recommend applying these process checks and the Trojan horse tactic in your next heavy industry audit. I'd like to know how you open the floor and come to me for any questions you might have. Feel free to use the chat or comment box to or unmute your microphones. Thank you very much.